Hello, this is Shane from VsCap Capital. Today I'm going to run through quite a clever spreadsheet which shows you how to profit from merger arbitrage. So what is merger arbitrage? It's really just betting on the likelihood of a acquisition or a merger. So the first step is to find a deal which you think is going to go through, then look at the possible regulators who might block this deal, then look at perhaps the potential shareholders, how much power do they have, and have they said that they like the deal. They'll generally come out with a comment saying that they're opposed or they're with the deal. So find a deal. So maybe it's Berkshire Hathaway, which is always a very welcoming company to be an acquirer, as they run companies well and they let managers do their own thing. So find the deal, then look at the structure. So here we have the key stats, which is the structure of the deal. And generally companies will offer a share exchange, a cash exchange, or a mixture of both. So this is an actual deal I was looking at last year which offers a mixture of both. So the acquiring company was offering spot 641 shares of its own company plus $19 in cash for every share that you owned of the target company. So these were the current share prices as I was looking at the deal. Select investment amount as 10,000. You can just have it as 100,000 or 1 million, whatever you want to do. But for simplicity, it's small, $10,000 or pounds, whatever amount you want it to be. So target company number of shares. This is really the key to finding the arbitrage profit. Is how much do you buy and sell of the acquiring company and the target company. So begin with the target company. I just did the amount invested divided by the current share price. The acquiring company number of shares is just left at 0 because we still have to work that out. We have to manipulate this so that if the acquiring company goes to 100, we'll still make a profit, and if it goes bankrupt to 0, we'll still make a profit as well. So the TC value is just the amount of shares times by the current share price, and the same for AC. So profit breakdown, the intrinsic value is a pretty important thing to realize. What exactly it is? Well, the intrinsic value is going to be the share exchange times by the price of AC plus the cash exchange. So this is the future amount of what you're going to be receiving. So you're going to be receiving spot 641 of AC for every share that you own of TC, and you're going to be receiving $19 in cash as well. So here's the just the current price. And here's the profit that you're going to be earning, because this is the future intrinsic value. So when the deal actually goes through, this is the price you're going to be receiving. So I think this is the future price. I've left this as just the current price, just assuming that it stays level for until the deal goes through. So now, how do we find out the breakdown of what we should buy or sell? Well, I took another table here where we have just a sort of normal distribution of the prices of AC. So you can see at the middle, 13.57. It's pretty much similar to the middle here. So it goes a little bit higher and a little bit lower. Potential future prices of AC. So this is just going to be a test to see if our total profit is going to be the same for if it's $20 as if it goes to $7. So remember, the intrinsic value of TC is entirely based on the price of AC, because you're receiving spot 641 in exchange of AC. So it's calculated in exactly the same way, except you're using the potential future price instead of this this price here. So profit from AC, it's just 0 because we're not holding any shares. And the profit from TC, as you can see, it's positive all the way down to about 7. But let's just, for this argument's sake, say it goes to 3. Then, oh my word, we're losing $1,000, which is not ideal. Arbitrage, we want to make a profit no matter where the price goes. So how do we do that? Well, first, if we just finish off this table, we can see that the profit from TC is just common sense. It's the intrinsic value minus the target price and times by the amount of shares. And total profit is just the profit from AC plus the profit of TC. That's perfectly fine. Now the profit breakdown, if you think of this logically, this is the sum of the total profit divided by 12. So in other words, you should be able to have a scenario where the profit at 20 is, as I said, exactly the same as 7. So here, you can see here, these are all exactly the same, and the sum, you can see here, is 23549, and the sum of all this is 23549. So in short, we want to use the solver function, and what I did here is I set the target cell as total profit. We want to maximize total profit. We want to change cell of the acquiring company, which is D3, and the two constraints we have are we want the TC value to be equal to the selected investment amount, and we press OK, and then we also want to have F9, which is the profit breakdown, equal to E9, which is the total profit. So if we click OK and we click solve, lo and behold, look, our AC company number of shares is minus 279, and our total profit for AC is the same if it's at $20, or our total profit is the same as if AC is at $20, and the same if it's at $7. And remember, we had a total profit of $1,800 before we did solver, and now the maximum profit we can make is $2,000. So on this deal, which actually happened, we got a total return of 21%, which was riskless profit as long as the deal went through, which it did. And that was over about a 6-month basis, so we had about a 40%-ish annual return, which is, pretty outstanding if you look at the risk of the market and the risk that was involved in this deal. That is quite subjective, but I thought it was quite low. So that's really how you calculate an arbitrage profit. I think this spreadsheet is extremely useful. It probably looks a little bit more complicated than it actually is. It's very straightforward. I recommend you downloading it in the description, playing around with it yourself, and I think an interesting study to do would be to look at all the deals and then look at the maximum potential profit from all the deals, and maybe set up a likelihood index for how likely all the deals are going to go through. But I think there's a lot of money to be made in merger arbitrage. A lot of hedge funds used to do it, and a lot of hedge funds conduct merger arbitrage went bankrupt in 2008 because it was one of the hardest hit, I would say, hedge fund sectors, because all the deals fell through as credit broke down. But in short, good luck with your merger arbitrage. I think there's definitely money to be made in this strategy, and I hope you guys do really well. Thank you.